Cool, thanks, Dan. Hey, everybody. Good morning if you're here in the U.S. When I heard Dan asking folks where they're from, I heard a lot of you guys are from Europe. We had Frederick in Zurich and folks in Amsterdam, London, Jamaica, all over the place. That's super. So before I get started, if you ever see me in a presentation, you know I have to give the disclaimer that nothing in this presentation shall constitute a recommendation to buy or sell any security. Trading stocks and options involves risk, and specific financial issues should always be addressed with your financial advisor. Past performance is no guarantee of future performance. And just a couple other little things. I am not a licensed financial advisor, and I don't want to be one. So what we're going to do today is we're going to have some fun. We're going to talk about trade ideas. I'm going to show you stocks that are set to soar and crash based on 3 words, proven track record. So it's going to be pretty darn exciting. At times, I may say, hey, you can do this, you can do that, or we can do this, or if this goes here. It's all from an educational standpoint. It's all in a paper trading portfolio. All right, so if you guys are ready to rock and roll, so am I. Dan was kind enough to give me a full hour plus some Q&A time, and we're going to see a lot of stuff. If you have questions as we go through the presentation, please feel free to ask. We are going to be looking at a lot of different stocks. So let's get straight to it. Let me pop up here what we're going to be talking about. So some of you guys may know, I launched a new company called Financhill. Beginning of this year, pretty much, we went live to the public, and we are getting a ton of incredible feedback. So what is Financhill? I'm going to tell you. This is what happens when you go to the website. You can type in any stock symbol. It almost looks similar to like a Google interface, sort of by design. It's just simple. Let's just type in the spiders. Once we're on the inside of Financhill, now this is where the fun happens. So I'm just going to stop right here. I want to ask you guys a question. What is the #1 challenge that we face when we walk into any trading day? #1 challenge. Probably, based on all the homework we've done, hours, maybe we spent a whole weekend, we still don't have anything better than a 50-50 chance of being right come the next trading day, right? We still don't know which way the stock is going to move. So Karthik, you said it, the direction. Totally agree. Now, we might have some personal biases. You might say, well, geez, I did a lot of homework and I feel pretty gosh darn confident that this little sucker is going to go higher. Yeah, I get that. But the bottom line is it's still 50-50. But what if I showed you, based on a stock's historical track record, nothing that I put into it, it's just the stock's own data that might suggest, based on its past, it has an 80% chance of moving higher over the next 10 weeks, or an 80% chance of moving lower. How valuable would that information be to have before you pull the trigger on your next trade? I would say, holy crap, I'd want to see that, right? So here's what we're going to do. When you log into Financhill, just type in SPY. If you said to me, Ron, I want to see the hottest stocks for the next 10, 12 weeks, this is all we're going to do. Once you're into Financhill, you just click Screen. You just click Seasonality. And then do you want to go bullish or do you want to go bearish? I can come in here and say, hey, over the next 12 weeks, I want to see stocks that rise at least 5% or beyond 20%, so minimum is 5%. Next 12 weeks, I want the accuracy rate to be at least 70%. If I come down here, I could select, well, maybe I want share prices of nothing less than $20. I want to cull out the herd a little bit. I think this is a hugely important piece of information. Minimum number of years of trading history. The longer a stock has been publicly traded, if they seem to buy or sell the stock at the same time every year, I think more data is helpful than less data. Not all the time, but most of the time. Now, the reason I go minimum 10 years, we're in 2017. If I back up to 2007, that was right before the market crashed, right? I need to incorporate 2008 and 2009. Not that I look at like a Facebook or an Alibaba, because even broken clocks are right, twice a day. So if a stock was up, publicly traded 5 years ago, it's like, well, the market's been up for 5 years, pretty much. So yeah, Facebook probably does go up every time, X and X time, right? I don't want Facebooks, I don't want Alibabas, I don't want Twitters, I don't want Snapchats, nothing like that. minimum decade. And this is something we recently added because our members wanted it. They also wanted to cull the herd in terms of volume. Now, I personally don't use it because I'll be my own judge of that, fair to say. But if you said, hey, I only want to see stocks that are at least trading 250,000 shares a day based on their 30-day average volume, you can do that. Now, once you pick what you want to see, you could come up here, hit the save button, and give it a name. You know, that's pretty cool. That's how I quickly popped in here. Now, check this out. Based on those settings, and if you would like to take a screenshot of this, and Dan's being kind enough to record this session, you can see a list of the hottest stocks based on the data we just typed in. And what are some of the companies that we see? United Airlines, which is actually in a big downtrend right now. And I love that, by the way. I love stocks that are going contrary to what the seasonality record says, because no one is going to pay attention to that stock except the big money. Here's Randgold Resources. We even have Amazon. We have Electronic Arts. We have Paychex. We have another gold stock. We have Dix, of all companies. Now, every time I come up here, and maybe you say, you know, 12 weeks is a little too much. Okay, how about we look out 8 weeks? Then what do we see? GameStop, Celgene, Activision, Gilead, gold, the stock, not GLD. We see C-Trip, even NVIDIA, Network Appliance, Biogen. My point by calling these names out is these are actually real companies that we've probably heard of. I'm willing to bet that all of us heard probably one of those companies before, maybe more. So the next time you walk into a trading day, instead of thinking, you know, I wonder if Apple has a really good track record of going up this time of year, or, geez, I wonder if Google's a bullish stock this time of year. There's no thinking. We can actually go right to Financial. We can save these settings that we go click, click, look, done. Boom, there's your stocks. The one thing to point out, though, is each time we lower the weeks and we go shorter and shorter periods of time, because we're only giving the stock a much smaller period of time to move, the gains will be smaller, right? Now, if we went out further in time, the gains could be bigger. So if you said, hey, I actually want to look out between now and the end of the year, because we know that the markets, or if you don't know, I don't mean to say that everybody knows, but the markets outperform from November to May. They typically underperform from May right now through November. So we're in August. We have August, September, October, November, December. 5 months, 4 weeks in a month is the next 20 weeks. And I can tell you it's actually 18 weeks because the market actually sidelines once we get into the December 15th timeframe. So over the next 18 weeks, look at these stocks. Now, when you see something that goes up 92% of the time, that stock might be a bit of a freak, a bit of an oddball. I would just discount that one. But look who else is on here. UAL, Network Appliance, Intuit, Amazon, MasterCard, Alexion, NASDAQ, Wynn, fantastic casino, Ameritrade. There's a lot of different companies in here. Now you know the hottest stocks even going out that far. But what if you said to me, you know what, I heard the market is pretty crappy this time of year, so I want to look for bear stocks. And just put a little note that we're going to come back to that little comment where the markets are crappy this time of year, because they're actually not. I'll show you what I mean in a moment. But let's just say you told me, hey, I want to look for stocks that go down at least 5% over the next how many weeks. Now, this is where things get really cool. And you can do all this research on your own. And I'm going to give you a totally free trial at the end. So there's nothing to buy. There's no pitch. It's just a free trial, no credit card. All I need is your first name and email. Dan will put that in later. We'll talk about that. So you guys can totally play around with this for free and just literally blow your mind. But here's something really, really important. When you're looking at bearish stocks, we can't get super aggressive, because if you look over the history of the stock market, there's a natural seasonal bias to the upside. Therefore, that's part one. I'm sorry, part two is we are in the summer where it's traditionally viewed as weak. You know, the talking heads on the financial networks are like, oh, it's terrible, terrible, terrible. I'm like, no, it's not. It's not great, but it's not terrible. But market just doesn't move that much. Hey, there's the bell. The market doesn't move that much. And we also know that in November, the markets go higher. So I want to be very specific and say, hey, all of August, all of September, That's 8 weeks, maybe 12 weeks into October. That's about as far out as I want to go. All right, and by the way, I'm going to show you the seasonal pattern of the S&P 500, and then you'll see what I'm saying is like, holy moly, that's actually right. Okay. Over the next 12 weeks, these stocks are now going to be bearish. But one more thing we got to change. I want to back this down to about 55 or 60% accuracy. Why would I want to do that? A couple reasons. Stocks just don't stay that bearish for that long. Okay? And they're going to quickly rebound, or at least not go down as much, because of the bias in the overall market is up. So if I just drop that to 55, again, I can come up here and save. And if I click this little button, you guys will see some of the saves that I've done when I've done previous demonstrations. Bearish, 55% next 8 weeks. If I just come up and hit that, all these settings will appear. So you can set your own filters and not be dilly-dallying around with all this other stuff. Share price, yeah, 20 bucks or more. Minimum years trading history, minimum 10 years. Volume, I'll just back it off. I don't really care. I want to see everything. When I come down here, we now have a stocks that trend bearish over the next 12 weeks. Anybody we know? LVLT maybe? Ocean Engineering. It's like, okay, this is interesting. Skechers. What happens if I just go 8 weeks? That is now August, September. Akamai. We just had a couple webinars at Financial. And maybe if some of you guys were there, feel free to type in and tell everybody what it showed. But Akamai has a ridiculously bearish track record this time of year. And if I'm a shareholder and I was walking into the Akamai earnings report, by the way, I don't know if we want to have a confessional here. Does anybody own Akamai shares? If you want to sort of say, yeah, it was me. I used to trade Akamai a long time ago, and there's nothing wrong with the stock. They might make an amazing product. The point is, if you back it up a week, it was entering a very bearish period. Had you known that this stock drops over 70% of the time by 15%, and you're walking into an earnings report, you should not have been surprised this thing was ready to crater. They talk about earnings reports being total crapshoots. They are. I mean, if you have insider information, you go to jail. However, if we use the stock's own record, and they have these weird biases where they go up 85, 90% of the time over a set time frame, or they go down by 70+% over a certain time frame, and there is an earnings report in there, all of a sudden that earnings report can be a catalyst and give you a theoretical bias of, oh dear, if I was holding Akamai stock, oh God, I wish I would have known this. Because if you were holding 100 shares of Akamai, this stock was in the low 50s. It was a $750 loss for every, I think it was 5,200 bucks invested. If you owned 1,000 shares of stock, you lost 7,500, and it just didn't need to happen. You should have known to protect that stock's value with maybe a collar trade, a long put. Maybe you just don't buy the stock. And we'll talk about this. In fact, let's just do Akamai now. Let's start there. So I'm going to bring up thinkorswim. I really don't care what broker you use. I like thinkorswim. I like TradeStation too, but I like thinkorswim specifically because of ThinkBack. That is the one edge I think thinkorswim has over other brokers for stock and options trading. So let me go ahead and type in Akamai. I'm going to do a 1-year chart. I can actually make this just a little bigger so I can still see you guys. So here's what I'm going to show you guys. We're right here. The stock is in a slow uptrend, right? It even starts running ahead of earnings. You might say, based on your own indicators, maybe you use Fibonacci's, Elliott Waves, Ichimoku, the cloud, not the rash, whatever it might be. And you say, wow, this thing looks great. Maybe you even saw someone buy a boatload of long calls. There was maybe some unusual options activity or something. And this is all running. And then you say, I think it might be a great opportunity to consider buying stock or long calls. And then you go to Financial and you say, oh God, thank goodness I didn't do that because the data said it was terrible. Let's go look at the data. To look at an individual stock, what we're going to do is hit search. We're going to hit seasonality. And then we're going to type in Akamai. Now there might be a small, okay, it's not too bad. I was going to say it might be a small delay because I'm screen sharing and demoing at the same time. Let me show you something over the next, because now a week's gone by. Here we go. 2 weeks, there it is. Here we go. Check this out. I'm going to read this to you. Oh, before I do that, let me just tell you what's happening. On the left-hand side of this chart up here, this line, that's what the stock has done. So the solid line is where it's been, okay? The dotted line is where it's expected to go, but time out. Read what this says. Probabilistic future prices. The software at Financial is not predicting the stock will go there. No one can predict where a stock will go. We can all guess, but no one really knows. Okay, so when we say probabilistic future price, what we mean is if you take all of the stock's publicly traded history, all the data that we can get our hands on, and we assign an equal value to that each week throughout the year, this stock actually craters right now. Look at that line. That's what it's saying. If the historical averages live up to their average, their mean, it does this. So over the next 3 weeks, Akamai has on average historically fallen by 10.4%. This is 17 years of data. This isn't accidental. Oh, the last 3 years, they had a bad CEO and they were just ripping off the company. We're talking about 17 years worth of reporting, and there's that kind of bias. Okay? Akamai has fallen lower in 13 of those 17 years over the next 3 week period, which corresponds to a probability of 76%. Okay, this is where I'm going to be a little cynical. When's the last time you walked into a trade idea and you said, I've done my research. I think this stock's going to fall by 10.4%, and I feel 76% confident it's going to happen? I'd probably say never, because we're all guessing. The software says, yowzers. Apparently, this particular earnings report in July historically is a stinker, or it's historically when no one buys it in mass. How can we come up with that assumption? Because the price went down. Stocks are only going to go down based on people selling, which then takes me into the next part of why does this even work? How can something like this be so in a way accurate? There's big money out there and it moves. You might hear it called sector rotation. Some people have had experiences with seasonality and maybe it hasn't been the most positive. Okay, I get it. I mean, that's like with everything, but it's just data for us. If you're an engineer and you're sitting there, you're probably smiling ear to ear because we didn't do anything quote proprietary to it. It's just data. Anybody can do it, but you can do it. The question is, how are you going to run the whole stock market in a weekend? Can't really do that. Maybe you could do it for a stock or two, but do you have 8 hours to go blow this weekend? Probably not. You'd probably rather go golfing or walk the dog or take the kids to soccer. So having access to this, knowing what the big money is doing is key. And the big money pushes these stocks around. Dan and his team is going to have a tremendous amount of traders here today in terms of quantity. If we all get together and we all try to buy Apple or sell Akamai, collectively, chances are we may not even make the ticker on CNBC. If we do, it's going to be what, one block trade? So when big funds are out there and they're pushing stocks around when they're sector rotating, maybe now is when they're rotating out of Akamai and they're going to soon rotate into Salesforce.com, which is a very bullish stock this time of year. I don't care what the reason is. Do not care. I just like money. And this says the stock historically goes down. When big funds get in, this is the next thing why seasonality can work so well. They cannot establish their position today. They're going to have to do it today, tomorrow, the next day, the next day, the next day. Maybe they're just going to, if they want to short Akamai, they're going to short it on up days. If they're going to go buy Salesforce.com, they're going to buy on down days, whatever it might be. And then when they get out, they have to get out over time. Otherwise, they're literally waging war against themselves, and they're going to hurt the prices that they can get. However, as retail traders, you and me, we can trade with literal surgical precision. We could buy a long put on Akamai and then get out of a long put on Akamai and pretty much not move the market, if we even move it at all. Okay, makes sense? So if I'm a shareholder of Akamai and I'm walking into this day and I see the stock slowly setting higher lows, slowly setting higher highs, which is the absolute definition of an uptrend, this was no shock. No shock at all. And in fact, the stock still remains bearish for the next 3 weeks. Does seasonality always work? No, it only works 76% of the time, and that's historically. It doesn't mean it's going to work tomorrow, the next day, or it's not going to work ever again forevermore. But what's astonishing is we were probably 50-50 on guessing the direction of earnings, and the software said something else. And our members that since we've taken Financial live at the beginning of this year in a public way, they're just blown away, absolutely blown away at how this stuff plays out year after year. A lot of these hedge funds, they get way too much credit. It's like, do they really buy the same group of stocks every year? You hear it about it all the time. It's sector rotation, okay? Now, what if we wanted to go out here and say, well, what do the next 26 weeks hold for Akamai? That's interesting. So it moves down historically, then it sort of belly flops around, then it starts running, then it pauses. What if we went out 52 weeks? Could we actually see Akamai for 52 weeks? Yep. So there's a question, how does this look? How is like a track record work? Or your track record literally is this line. This is all the data, all averaged up. You can see the peak is in July. So when you get into July and then we start moving down, to be prepared that Akamai could run into trouble from a historical probability perspective. And this is where we are right now. And this is what the data, this is where we are now. This is over 52 weeks. But if I come back in to 3 weeks, we see what that data says. So here's like the warning shot. Think of it this way. How many times have you looked at a stock and said, man, that thing was in a downtrend. And then all of a sudden, it literally has a rip your face off move higher. You're like, now, wait a minute. I was looking at this stock for the past 2 weeks. Are you kidding me? Where'd that volume come from? And why is it up 10% in a week? I don't get it. Because the big money rolled in. It wasn't you and me. We don't have the money to push these stocks. The big money does. Maybe you are big money. I don't know who I'm listening to, but I have a feeling most of us are retail traders. I'm probably not talking to the big hedge funds out there. I don't think John Paulson is listening. All right, cool. Now, let's go. There's so much I can do here. Let's go take a look at a stock. Ooh, I know what we're going to do. Let's do this. Let's bring back Thinkorswim. We're going to have some fun. Right there. All right. I know it's sort of middle of the week, but here is a question for you guys for this weekend. If you're at a party, maybe it's a summer picnic or something, you're at some friends' houses, or maybe kids are around, right? Ask your friend when Walt Disney is bullish and bearish throughout the year. And then be very specific and say, hey, John or Jane, is now a good time to buy Walt Disney? And just see what they say. My guess is that the average person, and I don't mean this in being intelligent and that's not what I'm saying at all. The average person would say what? What would you think? You'd probably say, well, geez, the theme parks are packed. Disney's probably making so much money. It's insane, right? Minnie's getting a new ring. But the stock actually historically does not do well over the summer. Can it do sort of well? It can. But pretty much from May to October, the stock is more of a stinker. It's more of an underperformer. That's probably contrary to what most people actually believe, because you'd think it would do better in the summer. So when does Disney actually turn into a magical stock, pun intended? November, like clockwork. So this was Disney last year. It was just going up, down, up, down, up, down, going nowhere fast. And I did a webinar, which I record all my webinars, so no one can say I didn't say something I didn't. And it's always a great reference point that says, hey, I actually did talk about this. I'm not just blowing smoke. And we were in a webinar in October, very small group of people. We were doing beta testing. And I said, hey, this stock is about to go up. Someone rightfully said, Ron, are you drinking again? I'm just kidding. They said, what are you smoking? Are you in Colorado? I said, no. I said, the stock's going down. I agree. I get it. But the data says that Disney is about to enter a rock star period of time where this little bugger goes up 80 to 90% of the time. FYI, Disney's been publicly traded 3 decades. So we're not talking about Facebook in 5 years or something. We're talking about 3 decades, different presidents, different turmoils. Maybe there's a war, maybe there's a debt ceiling, whatever it might be. It just goes up. The next question was, so how do we know if seasonality is going to work? Because you said earlier, Ron, that seasonality doesn't always work. I'm like, you're right on. I am not going to buy or sell a stock blindly just because seasonality says something. This could be the year it doesn't work out. Even if we were able to find a stock with a perfect track record, doesn't mean this year it's going to work. Fair? Okay, so I said 2 things. We're going to watch for a breakout, and we're going to watch for volume. There's one place, the big fish, and I call the big fish the institutional type volume, the big volume. Call them the big piggies, the big cows, the big elephants, the big fish, whatever it is. When they come in to feed, they leave a mark with volume. All right, I'm gonna move the slider. Now check this out. Oh, what do you know? Volume spike. Now I'm not gonna give you some kind of scientific equation to keep track of. All I'm saying is use your eyeballs. If we start seeing volume popping over previous volume, that's more volume than previous volume. So big money's coming in, and that should be reflected in the price. Well, here's a candlestick, and there she goes. Now I love candlesticks, huge fan of candlesticks. If you only gave me 2 instruments to use in my trading for stock trading, it would be candlesticks and volume. Other stuff's great, but those are the bread and butter in my opinion. There goes the candlestick. It is bullish engulfing. We popped up, and there it is. Now, I could consider going long now already, but here's the funny thing. There are 2 moving averages that I think longer-term traders should really keep an eye on. The orange line is the 50-day SMA, so it's 50-day SMA, simple moving average, and the purple one is the 200-day simple moving average. These are viewed as institutional-based moving averages. When stocks are above these, the stock is viewed as bullish. When the stock is below them, it's viewed as bearish. You've heard of the death cross in the S&P and the Dow. That is typically when these, in this particular case, when the 50-day would cross the 200-day on the spiders or the diamonds or the SPX or something, or the NASDAQ. So it's a big deal. So you actually will hear this talked about on the major news, the major financial networks. So here's the first sign volumes coming in. But we really haven't broken out yet. Now, I don't want to get too granular here, but I do love reading charts. All I want to do is say, hey, let's break out above previous highs. Show me that you got some power behind this move. Oh, and there it goes. It actually breaks out. And then what happens? By the way, the very end of October, I just say November, but it's actually the very end of October. And then in November, it becomes a rock star. I purposely want to stop right there. Look at another big bar. Volume is not getting huge, but we're starting to see bigger volume come in than we did previously. But then Disney was coming into earnings, and the volume actually spiked the day before earnings. And this is hilarious because we're on, I'm on record talking about this. I said, we're going to see if Disney actually does well. Why? 80, 90% of the time it goes up. So the only way that's going to happen and stay up is if volume were to come in. Someone 2 days before the earnings report was starting to pile in. It's almost as if they knew what was going to happen. There goes Disney. Now the volume just explodes. There goes Disney. The volume bars stay high. So whether you're in here, or you wanted to play it closer to the vest. I don't mean being a scaredy cat. I just mean, hey, earnings are crapshoots, supposedly. So wait till after earnings. And then consider getting in around maybe 96 or 97. What happened to the mouse house? Oh, dear Lord. And there it goes. From here to here. This stock went from, even if you waited till 97.50 or so, which is well after the fact, it reached 115. And here's what we teach our people at Financial. Super simple stuff. The red line is what you call a 2-0, a 20-day EMA. Pretty much every brokerage platform should have that. It's really great for what I call momentum swing trading, where you might, let's say, buy a stock and hold it maybe for a couple days or a couple weeks or maybe even a couple months. And when stocks have long trends that they're really running in, they'll typically stay above this red line. Not all the time. Some stocks don't do it at all, but that's all we're going to use. And it didn't get below the red line until April 10th by a few pennies, and then it finally got stopped out. You're talking about something in the $97 area, and then maybe getting out around 111. So that's what, 3 plus 11, $14. And that's the conservative trade. From the point where we talked about on October 27th, it was up over 20%. Stock movement. If you are an options trader, you can probably, I know what's happening, you're smiling ear to ear. You're thinking, oh dear, stock gods, 20% stock move if I'm trading options. It was, I think, it was just under 300%. It was 296% return. And the long call option only cost $420, if my memory serves me correctly. I have a document that we keep tabs on, and we just talk about, hey, we're talking about this stock, let's see how it does, sort of thing. So $420, 296% return. And all you did was follow the red line using seasonality. That's it. So, would you have actually held it that long? Someone typed in, Ron, I would go insane if I had to hold a stock for 5 months. So I had to think about my response because I have a really dry sense of humor and I'm very sarcastic. And I said, wait, you have a problem with 296% in 5 months. I think you might have other problems. We were joking and laughing. And I said, so that's not the whole trade. This is what I teach. When I first started trading back in 2000, when I started researching the stock market, I did everything wrong you could ever do. I blew up accounts, more than one. It's not something you really want to be good at, trust me. But I just did everything wrong. I had ants in my pants. And then someone told me, you're trading with one contract. That's really hard to manage, because I was learning. And they said trade with 3. And I was like, well, that's 3 times, triple the money. They're like, yeah, but it's going to solve your mental problems. I'm like, I don't know about that, but okay, whatever. I got a lot of problems. So it made total sense. So what I like to teach people is, listen, if we can afford it in a paper trading account, let's buy 3 long calls on whatever stock we want to purchase. I don't care if it's seasonality or something you find on your own. But with the seasonality aspect, let's do this. The first long call, we're going to close at a 20% profit. The second long call, we're going to close at 100% profit. Why is it 20% and 100? Because I just made it up. 20% makes you feel good. It's a decent number to shoot for in options, I believe. It's not that aggressive. And we're going to pull one contract off. So hypothetically, if we use the Disney example, and let's just round it off to a $400 example, and let's just say we got in after earnings for fun. We wanted to be more conservative. Let's just say we paid about $400 for an option. Well, pretty quickly it was up 20% here or here. So a week or two later, We're pulling 1/3 of the trade off. So now our risk is automatically being reduced in the overall trade. And we feel good about making a good decision mentally. The second one, 100%. Now we're in here. Why 100%? You've doubled your money. If you trade options long enough, you're going to know that that's really hard to get. Now 2/3 of the trade is off. The third piece, that third long call, now we can sit back, we can close the door, make sure our spouses or friends aren't watching, and we can start squealing. Oink, oink, oink. And we are going to follow that sucker and let it run as long as it can. Because as traders, that's one of the hardest things that we have. We never know when to sell, and we often cut our winners too soon. We all have these gremlins. One says buy, one says sell. We've all had terrible trades. And you start saying, man, I got some money here. I better take it because I got to pay for all those losers before someone finds out. Blah, 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 blah. Right? We've all been there. You've already pulled 2 contracts off. If there was ever a time to be greedy, I would argue, now let's go be greedy. Because if we're wrong, the stop is this red line. You know, if the stock would have gone up and then we get in and then it immediately goes down, if it gets below the red line on closing basis, we just exit the entire trade and no profit is made and we lose money. You always have to remember that if you're trading options, you could lose all the money that's invested from a long put or long call perspective, because it's a debit trade. So we don't over leverage. We use proper risk management. So what I want you to do is when I go give you that link for that free trial, which doesn't cost you a dime, there's no credit card, it's just the first name and an email address. Spend the next couple days and the weekend playing around with the seasonality filter. See how these things can work out. Use a stop system that you might find attractive to yourself and see how it works. And I think you're going to be saying, wow, that's actually pretty cool. So very simple exit system. And, you know, it's incredible. Let me ask you something else. And you can be very blunt. I don't mind. Because if you come in and you're actually in a live webinar with our members, they will tell you how unbelievably much better they're doing as traders than before. So here is a question for you. Who here thinks that seasonality worked so well because we had an election and everything went up? Don't worry, I'm not going to eject you. I'm asking a fair question. Because if you never heard seasonality before, you might say, actually, I sort of believe that. Everything went up. What did Warren Buffett say? What's one of his quotes? That a rising tide lifts all ships, right? So if the market's going up, even the not so good stocks go up. So I agree with that. It is possible. But you have to remember, though, Disney's publicly traded for 30 years plus. We didn't just have only one presidential election. We had quite a few over 30 years. So there's data to support why seasonality works. So let me show you a different stock. And I promise you we're still going to get to trading ideas because I'm watching my time, okay? I want to show you something just in case you're skeptical, because I'd be skeptical. There's a lot of crap out there in the market. Good crap, bad crap, you know what I mean. There's a lot of stuff. Here's the election right there in the center of your screen. So when Trump was elected, the markets went nuts, right? Spiders went crazy, the diamonds, the Qs, the banks, even the banks. It was wow higher. Adobe went higher for one day, and then it immediately went down. This would be my luck. I would literally pick the one stock that wouldn't go up when the whole market goes higher, right? We've all been there, done that. And then what happens? It actually does bearish engulfing 2 days later, but it bounces down, then it goes up, then it goes down. It hits the institutional moving average, the 200-day moving average in purple, and then it bounces. So meanwhile, the market's going like crazy, crazy higher. And here, let's pretend we all have this stock. Here we sit with like one of 2 stocks that aren't going up, right? All right, earnings. We're getting ready to earnings. That little dollar sign at Thinkorswims means earnings. Now we're thinking, rubbing our hands together, right? Oh, here it comes. Finally, the market's bullish. It's the holidays. You know, everything goes up. Now's when it's going to go up, right? Nope. Gap's higher, bearish engulfing again. Look at the volume. They did not want to buy this stock at all. Now you're thinking, now wait a minute. The whole market's going higher. This stock isn't. Now I have earnings in a seasonally bullish time of year. January is great for the markets. And then we go down. Are you kidding me? And what happens then? You probably pulled the trigger and sold the stock. It's like, I have got to go trade Apple now. Everything else is going up. Apple, Facebook, here we go. Okay, that's fine. However, when we were in December, had another webinar for a small group of beta testers. And I said, guys, I know you're not going to believe this or not. You won't believe this, but Adobe is one of the best performing seasonal stocks literally on January 1st. This stock has an 80 to 90% track record of going higher by a ton. And we looked at this and said, wait a minute. If the election can't make the stock go higher, I'm sorry, the election is here. If the election can't make the stock go higher, and a fundamental earnings report in a bullish time of year with the market soaring can't go higher, what is going to make this stock go higher? There it goes. And I love trying to tell that story in a certain way, but there are reasons why this stock could have gone higher, even fundamentally. And only when the calendar turned did this stock become a rock star. And there she goes. This was also, I think, a 200 ballpark, 80% return on a long call at the money. We typically will go out a lot of times roughly 6 months or close to it on a long call. Don't really expect to hold it 6 months, because I got to tell you something. It's sort of hard. I like to trade. It's sort of hard for me to sit still that long. You know, you get ants in your pants. But it's not the whole portfolio. It's just one small piece of the portfolio. And I don't know about you. I sort of like money, right? I don't care if the stock is Philip Morris, Altria. I don't smoke. I don't like cigarettes, but I like money. I don't care what the stock is. I'll trade it. And there we go. Even the earnings announcement, gap up, pulls back, off to races. Only here on May 17th did it finally close pennies below the red line. All you did was come home from work. Where's the stock? Where's the red line? Where's the stock? Where's the red line? Oh my goodness, this is taking 5 seconds. It's ruining my life. You get the idea, right? So once Adobe broke out, which was on January 6th, a couple days later, 20%. A couple days later, 100%. Third one, oink, 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 and we just run it. If at any given point during this time it would have been poof and it breaks the 20-day, then we get out. So my point is, whether the stocks are bullish when everything else is or when they're not, the seasonality comes in again and again and again. And just look at the volume picking up, slowly rising, slowly rising. Then they even bought more on earnings, and it still goes higher. All right, so those are the two examples I'd love to use as a contrary. Disney went up when the market was surging, and Adobe was a real stinker until the new year. And I showed you Akamai, who is a pretty poor stock right now, right? The next thing is earnings reports. Let me just go back to Disney real quick. If I go out 52 weeks on Disney, you can actually see historically it does not do well. It goes from basically 0 down to -3. So historically, it's only dropping by about 3% half the time. That's not a crazy bad track record. But look when it starts to bottom, right in that October timeframe, right? Right at the end of October, beginning in November, there we go. And look where we are again. Once May gets here, it starts getting weaker. There's not much of an incline, and then we start rolling over. Now, right now, Disney's actually doing a little better, but from a historical perspective, now's not the time to own Disney. But you might say, but geez, always Ron, look at the Disney stock. It's going higher. Look. I get it. I don't want to trade the stock when its own seasonality says it's 50-50 going into earnings. I can do that on my own. I can play pin the tail on the donkey. What I want to do is get into Disney when it says it goes up 80, 90% of the time. So I actually have very specific times of year when I want to look at certain stocks. Disney is on our hit list for November, just like it was this past year. Adobe, AMAT. There's stocks like Penn Gaming. You might say, well, geez, that's a pretty cheap stock. We were talking about Penn Gaming at the end of February. All we said was wait for a break of the trend line. Here's a little $14 stock, and it goes bonkers. So this was about a month and a half trade before it stopped itself out. I mean, this was just crazy. Why did it go up? The company happens to pre-announce in March. Do you think that's an accident? I don't think it's an accident when the data said roughly 90% of the time this stock goes up by double digits in the next 45 to 90 days. So guess when those pre-announcements are likely to happen, and guess how they're usually going to come out as? Better than what people were thinking. Whatever the reason, the seasonality just keeps playing and playing and playing. Okay. Now, something else I told you guys I wanted to show you was the spiders, just using seasonality. And if I were to go out over the next 8 weeks, which will be, hang on one second, just got to watch my time here. The next 8 weeks is all of August and all of September, right when the kids go back to school on the East Coast. If I scroll down using the seasonality screener, look what happens. Over the next 8 weeks, the S&P 500 ETF, 500 companies, historically has gone up by 0.8% based on the past 24 years of stock performance. So it goes up by 0.8%, 66% of the time. Anyone that is in those buy and hold camps that thinks they're going to make a lot of money on the S&P this summer, historically, they don't, historically. The market goes nowhere. Remember how the talking heads come on and they, oh, I'm on a recording. I got to talk politically correct. Certain financial news networks, not to be named, have a habit of putting on people, you know, not just people, because I don't want to say it that way, but they run headlines. They like the fear factor to scare everybody. Oh, it's sell in May and go away, and the market just crashes, and it does not. Maybe if you measure a crash throughout history, there can be a specific month that might be more susceptible to a crash. But from a historical perspective, they're absolutely wrong. They like to imply the fact is the markets are going to crash. They don't. Anybody with access to a brokerage account and a pencil and paper can do the math and say, no, they don't. What they really mean is, but they don't really want to say it because it's not sexy. The markets go nowhere historically from May to November. Because even if I take this out, let's say 12 weeks, now we're going out 3 months, August, September, even into October. Look at what the plotted line is, the probabilistic future price based on its history. Over the next 12 weeks, the S&P 500 has historically fallen by 0.4%. Well, that's not exactly the bear showing its teeth and we're all going to get killed, is it? It's fallen lower in 11 of 24 years over the next 12-week period, which is 45% of the time. Let me explain that. So less than half the time it falls. That's correct. That's because the losses are greater than the 55% of the time the market finishes higher. My point is, are you really going to freak out and sell all your positions because the market declines on average by 4.4%? No. No, you probably wouldn't. Maybe you would, but I don't think you would. Now, there are months of the year, like August and sometimes October, that from a pure monthly probability perspective, if there is going to be, quote, a crash, that is when it might happen. But when you actually look at May to November, it's not that bearish at all. So what I think is super important as a trader, knowing that the S&P doesn't go anywhere over the summer, isn't it even more valuable to be able to go to screen, seasonality, and say, well, if the market goes nowhere over the summer, wouldn't I want to have a list? I can actually just do this. Wouldn't I want to have a list of stocks that actually go higher, knowing the S&P goes nowhere? Wouldn't it be great to actually know which stocks actually do move? It's like, did you ever wonder, man, I wonder why those biotechs seem to run up this time of year? The software would have told you. You would have known right away that you better be focusing on Celgene and Gilead and Alexion. Does that make sense? Because here's one of the things I like to say. I really don't know why they do it. And if they do it, I think I might want to, I'm like, maybe they listen to a presentation. When you're listening to whether it's CNBC, Bloomberg, Fox Financial News, whoever it might be, why do they always bring these people on and they say, you know, the semiconductors are up 20%. Is there any fuel left in the tank? We've all heard it. Like, no. Do you know what really would have been valuable to me as a trader? Is if you would have told me, we're entering a seasonally bullish time of the semiconductors. This is typically the time when they go up 20% over the next 3 months, and these are the best ones that do it. Now that would be valuable information. Do they ever do it? The answer is no. So we built Financial. You guys can get access for a 14-day free trial. I am going to, and by the way, this is only one part of that free trial, one part of the site. The free trial that you guys are going to get access to, I'm going to put a special link in here. It won't let me, will it? Let me see. Control V. Yeah, there it is. I'm going to give you guys a special link. Dan asked me if I could do anything special for all the folks that are listening today. So if you copy and paste that link into your browser, it's going to take you to this page. And I promised you, it's only going to ask for your first name. It's only going to ask for your email, and then it stops. You click sign up for a free trial. There's nothing to do when the trial is over. It's like a Mission Impossible movie. It just goes, disintegrates and explodes, and it's done. There's nothing to cancel. I would love for you to go play around with this. What I'm going to do towards later this month is I'm going to have a live webinar. I'll invite everybody who does a trial into it. And you guys can actually, we'll get much more in detail into what the site offers. But that was just seasonality. We have something that is stock score. You can actually start with search stock score. If you're a trader that doesn't want a whole lot of effort in the market because maybe you have a busy life, you just don't want to trade that often, we've built a proprietary algorithm that takes into account the fundamental, basically like the balance sheet data of a stock, the technical analysis of the stock, meaning the chart, sentiment-based analysis, and then we even layer in the fourth piece of the puzzle. There is some seasonality. So each one of those four have a different weighting or a specific weighting. I can't tell you what that is because it's proprietary to us. It's what makes this unique. So instead of trading with just seasonality, which is what we spent most of our session on today, you said, Ron, I love seasonality, but I'd like there to be a few more metrics. That's what stock score is. And we made it super simple. Green means go, red means sell, green means go. So green is buy, red is sell, green is buy. While everybody's telling you the S&P is overvalued, depending what metric you use, you're right. I think we're going to go to insane new highs. We ain't seen nothing yet. This is a capital thing. This is not an economy thing. Money is flooding our markets from around the world because they don't know where to hide it. They don't know where to put it. They don't know where to get a return. I won't get into that here today, but there's so many reasons. And yet they keep parading people on TV saying, oh my God, it's going to crash. It might crash. We might get a crash. But they've been saying that pre-election. They've been saying it post-election, and all the S&P does is keep going up. So if you want to put your fingers in your ears and sort of black out all that noise, if you'd like to, you could follow along with our stock score. Green is bullish, red is bearish. Now, when it goes red, which it actually did for the election just for one day, which is funny, it doesn't mean you have to short a stock when it's red. you can just say, okay, I'm just not going to be bullish. If it goes red, you can consider buying a long put, making it a collar trade. Which then brings the question, if seasonality is bullish, but stock score isn't, what do we do? Well, you could wait for stock score to go green too if you'd like that extra comfort in knowing that there's more than just seasonality pushing the stock higher. We have a lot of members that do that, but we also have a lot of members that just do seasonality because they love it. They love the fact that there's literally zero human input in there. It's just data. If you use it on Disney, for example, some stocks will give you more buys and more sells than others. Disney was actually on a sell, and this was the funny part last year in October, because Disney had gone on a buy, and someone said, "No, wait a minute. You're telling us that the seasonality data says the stock's going higher." I'm like, yep, it is. But your stock score now just went on a sell. I'm like, it is what it is. So what do we do? I said, well, frankly, the seasonality doesn't really turn bullish until the end of October, beginning in November. So why don't we wait for the stock score to go green again before we go bullish? And then look, it stayed green for 5-6 months before we went red again. And May is when the stock typically starts to get weak, and that's exactly when it went back red again. If you actually want to look for stocks, you can go screen and you can go stock score. You can search for stocks that have just had rating changes. You could say, listen, I want to look for stocks that just went on a buy and only moved a couple percent in the last 6 days. So I can go down this list and say, oh, geez, let's go find stocks that just went on a buy and maybe think about trading those. So we can tell you that too. You can also look for just sells. But the thing I was really pounding home for our community at Financial this past week is if you have companies that have earnings reports, going to the search seasonality and typing the stock in, typing in Akamai and seeing that there is such a pervasive move to the downside, it tells you right away that holy moly, maybe now is when I want to protect my shares so I don't have my portfolio crushed. Sometimes you're going to type in a stock and there's no bias. There's nothing wrong with that. It just means there's no bias. But when there are biases, man, I don't know what else to do other than just, it's like you're yelling from the rooftop, please be careful with Akamai. Please, please, please. You should not get killed on this. You knew if it was going to happen, this is the window it's going to happen. It's sort of like, the analogy I use is, if you're going to book a cruise, don't book a cruise in October. Why? If you're cruising around Florida in October, it's hurricane season. You just put yourself in a potentially rougher situation than maybe you need to, right? Or, if you want to go see the migration, here on the East Coast, we have Canadian geese. If you want to see Canadian geese migrating, how about October, November when they're going south? Or if you want to see the whales in Hawaii, you do it December to March. You're going to go now, you're not going to see them. That's seasonality too. So it's all over the place. You can put your watch list in. So you can actually type in your stocks. We'll even give you the seasonality of your own stocks. So these are all stocks that I'm watching. We have lists, we have value investor stocks, which is, I call it like Buffett type criteria. We also give you guys newsletters. So there's a lot here in the site that you guys can get access to. What I'm going to do now is spend my last 10 minutes doing a question and answer. Hey, Dan, thanks so much. So Dan just put that link in again. That link for a free trial is going to take you to this page. It's just a special link that I know you came from Dan, and you can start playing with it immediately. All right, let me start hitting some of these questions. Pop that out. All right. There was, oops. Oh, it just reset on me. Give me 1 second here. The question box is just being a little difficult. Okay. There is a new speaker coming on. It'll be the bottom of the hour. Yep. Can you check Apple? We can check Apple. I'm assuming you wanted to do the seasonality. If we look out the next 12 weeks on Apple, you can actually see how it performs. There's a surge, there's a pullback into October, and then she goes on a run. And this is helpful, for example, if you're thinking about doing covered calls. Oh, which, by the way, if you guys go to screen, there's also a covered call screener in here too. You can get access to that for complimentary 14 days as well. But when you see stocks that typically start rolling over and they have patches of time where they don't do anything, like the S&P right now, it's covered call time. If there was ever a time I wanted to try to earn income on the stocks, it's when they're going nowhere. And then when it looks like there's a bias to the upside, I want to be selectively greedy and not short calls on my stock. Just let it run. You know, if it starts breaking moving averages, well, then I can think about collar trades, married put strategies. Out of curiosity, let me just mute myself. I just have to clear my throat. Give me 1 second. Out of curiosity, who here is a credit spread trader? All right, the link is not taking you to my page. Let's try that again. The link is working. All right, so let me do this. I don't know why the link isn't working, but let me do a copy paste here. Let me just see what we're sending. Chat. Oh, there, yeah. That link should work. Let me just click on it for Dan. Yeah, that link's working. If that link doesn't work, try this link. But it is working for me. All right, so here's the thing. I said, who here is a credit spread trader? And you guys are starting to answer. We're going to do our bullish stocks. I'm just going to come up here, put 70%, 8 or 12 weeks, doesn't matter. Here we go. So what do we got? 12 weeks, 70% looks good. If you are a credit spread trader, you know that by definition, credit spreads can profit in multiple directions. Meaning if we do a bull put spread, we can make money if the stock goes straight up. We can make money if the stock goes up at a 45-degree angle, a slower uptrend. We can make money if the stock has a sideways trend, a trading range. We can make money even if the stock goes down a little bit. Just don't come down to our short put strike price. Right, credit spread traders? Everything I said is absolutely true. So by using a credit spread, you're giving yourself a chance to win in 4 of 5 directions. You inherently have a better chance to win than that other person over there that's just buying stock or buying a long call, right? Because you have an array of ranges to win in. I love credit spreads. Can you now imagine having access to Financial and being given a list of stocks on a silver platter every day, every week, every month that actually have incredible biases to the upside historically, and then doing a credit spread on these stocks? I don't know, but it sort of gets me excited. It's almost like a perfect match. So instead of picking just any old stock that you think might be bullish, why not pick a stock that has a 70% track record or an 80% or a 90% track record? Then go look at the stock chart and see if you're comfortable with it, and then consider maybe doing a bull put spread. Yeah, I think it's absolutely wonderful. So we have a lot of credit spread traders at Financial as well. All right, so I put that new link in there. You guys are telling me that one's working. I'm just going to put it up here just to show you in case you need the raw link itself. It's financial.com/offer/MT-platinum. So it's a little bit of a funny link. Or if you can use the link that Dan put in, that raw link should work as well. All right, let me see some other comments here. and I'm down to about 4.5 minutes. All right, Here we are, now I'm back. Oops. Let me just see what's working, what you guys are talking about. Okay, somebody asked about trading, looking at Facebook. Because Facebook is so newly public, I just don't believe it's an accurate representation of how seasonality could potentially work. Same thing for Tesla. You know, they're too new. All right. Just looking for other questions here. This free trial will give you access to everything at Financial. We call it the All Access Pass. Right now, there is no credit card required, so you have zero risk. We can never charge you if we ever wanted to because you're not giving me your information. All right. Somebody asked if I could look at USO. And because there's so many of you typing, it's going very quickly, so I'm not going to go look for the person's name, but this is for you. Historically speaking, you know, here's USO. It looks like it doesn't do well, right? If I go out over 10 weeks, USO has fallen by 6.1%, with 72% of the time, if we were to go out 10 weeks on USO. That's not very good. Doesn't mean it can't, and USO is going up right now, but historically speaking, now is not a good time. All right. So Dan, thanks for putting that link in again. I'm going to give them the alternative link as well. Somebody asked about Tree, which is Lending Tree. If we were to go out, let's say, that was my alarm to make sure I don't go over. Here is 12 weeks on Lending Tree. Over the next 12 weeks, Tree.com, which I think is Lending Tree. Hope I'm not I don't trade the stock. Let me just see. Yeah, it is Lending Tree. Okay. And right now it's very bullish. Has risen 9.3% on the past 8 years, so 50% of the time it goes up. So you might look at Lending Tree and say, well, it's going up a lot right now. The data says it only goes up half the time. That's not helpful. Actually, I think it's just the opposite. It's very helpful. I'm sorry that I wasn't bullish on Lending Tree, but it was a 50-50 guess. I don't want 50-50s. I want 70, 80, 90% chances to be right. Does that make sense? But you can also see that even though there is a very, very strong move here, once we get into September, it goes nowhere and it's dead weight. So even though there's a strong move, it doesn't go up by a great percentage of the time, but there is a strong move historically. So earnings is actually showing us. You see how the difference is? It's showing us that, yeah, Lending Tree goes or has gone up a lot right now, and it's doing it right now. So it's working in that sense, but the probability is only 50-50 that it does that. There's a lot of years it doesn't go up. In fact, it goes down, and then it goes sideways. All right, couple other questions. Seasonality will or will not work well for popular companies. It works on everything. The question is, to what percent does it? You know, seasonality can be applied to any stock, any commodity, anything. It could be applied to, I'm sure we could run something on wildebeests and their migration if we wanted to. It's just data crunching, that's all. How many years of data does it use to arrive at seasonality, David? It uses all the data that we can get our hands on. So we buy our data and whatever data is available. So we say everything. For me, I think it's minimum 10 years for me to want to believe it. Not sure I got the right link. Okay, Dan's helping you with that. We do not trade portfolios, nor do we trade other people's money. So I am not licensed, don't want to be one. It's a completely software-based site. We do give you guys trade ideas. In our newsletters, we'll actually email you some trade ideas. It is US stock-based. We are working on getting Canadian stocks, but it's not there yet, and it's taking forever. So I don't want to promise you a date. but right now it's US only. All right, so I have bottom of the hour. I just want to say thank you to Dan and his team for inviting me in. I would like to thank all you guys here today. I appreciate you coming in so early here in the US. If you're overseas, good afternoon. Nice to meet everybody. The link is there one more time. If you have any questions, our email address is care, which is CARE @financial.com. You can drop us an email, but you should receive your login credentials within 10 minutes of signing up, okay? And again, it's a completely free trial. There's no risk. Send me your feedback. Let me know how much you like it. So Dan, thank you to your team. I am gonna have to run, and appreciate being here. Have a wonderful day, everyone. Thanks again, Dan.